Hi everybody, Marco Carvalho here from businesscreditblogger.com. Today's video we're going to talk about line of credit versus credit card. This particular video you're going to learn the difference, and we're going to focus on both personal lines of credit and personal credit cards and business lines of credit and business credit cards. We're going to share with you the difference between an actual line of credit and a credit card. More importantly, we're going to share with you how to qualify for personal and business lines of credit and credit cards. So let's get started. Now, as far as there's some similarities between a line of credit and credit cards. The first and foremost is they're revolving sources of credit. So if you're looking for a revolving credit where you can use your access to capital over and over again, once you use it, you pay down the principal, it becomes available again. Both a line of credit and a credit card serve that purpose. Where when you get a loan, you know that's a one-time cash injection, and as you use the funds from that loan, you're done. You have to go get another loan, and you have a fixed monthly payment. So revolving sources of capital are tremendous value for you on the personal and business side. Also, you have access to a preset credit limit with a line of credit versus a credit card. They both have that similarity. They have a credit limit assigned to you, and you can't go over that limit. You can borrow against your credit line whenever you need it. You repay it and use it again and again. So both of the line of credit and credit card have that same function. They have that same benefit. You can maintain a revolving balance with a line of credit and a credit card. So if you have your preset credit limit, you charge it up, and let's say you want to you don't want to pay it in full every single month, you could carry that balance and pay what's called a minimum monthly payment. So that's another similarity between a line of credit and a credit card, is you can pay a minimum monthly payment. It doesn't have to be paid in full every month. Where there are some types of credit cards, just so you know, they're called charge cards, where you do have to pay it in full. So that's basically like it's not revolving, where you can carry a balance. So the majority of credit cards, though, allow you to carry a revolving balance unless it's a charge card. Now, let's talk about how it's used, the difference between a line of credit versus a credit card. A line of credit is accessed using, you get convenience checks, and you can also access your website login that's provided to you by your bank when you have a line of credit at the bank. Or you can call them over the phone, so you need to transfer funds into your account, or you can go in person and draw on your line of credit. So those are the different ways you access the funds that you have with your line of credit. With credit cards, it's a little different. You get an actual physical credit card with depending on the bank that issued you the credit card, it has one of the network's logos on it, whether it's Visa, MasterCard, American Express, or Discover. So you can use that card, that physical card, anywhere Visa or MasterCard, American Express, or Discover are accepted. Also, you can use your credit cards, obviously, over the phone if you're giving your credit card number. They ask for your security code on the back, your address, etc. So those are ways you can use your card. That you can use it. Also, if you want to pull cash out of your card, you can also call the credit card issuer and request a cash advance. So those are kind of some different ways. On credit cards, you have an actual physical item that you can use, but also has some functions like a line of credit, because you can use the card number over the phone. You can use it online. So many times your credit card doesn't have to actually be physically present to use the credit line. Obviously, you know that. So, that's the difference between the line of credit and credit card as far as how they're actually used, how you access the capital. Now, what's the best applications for a line of credit versus a credit card? A line of credit, because you have a higher credit limit availability, it's very beneficial if you're going to make major purchases. So that's one of the big benefits of having an actual line of credit. Whereas if you have a credit card and you make a major purchase, obviously you know you have your annual interest rates are higher on credit cards compared to a line of credit. Line of credit interest rates are much lower. We'll get into that in a minute. So that's why they're good for big purchases. Also, a line of credit is ideal if you're looking for pulling large amounts of cash. You need it for working capital, or if you're a real estate investor and you're looking to access a large amount of cash for a down payment on an investment property, a line of credit is more beneficial for you. Whereas if you're going to try to get a lump sum of cash on a credit card, you know you have to deal with cash advances, you have to do balance transfers to avoid those high interest rates. So that's why a line of credit is beneficial for those two applications. Where credit cards are very beneficial and they're best used for if you're looking to make small purchases. They're excellent. They're very convenient for day-to-day expenses. And if you want to carry a revolving debt, small amounts of it, credit cards are very useful. Also, if you're looking to benefit from rewards, credit cards offer many different types of benefits. Like we're going to get to that in a minute, but cashback rewards, travel rewards, etc. So that's what they're best used for. Also, keep in mind, both of these types of a line of credit versus a credit card, they both help you build up your personal credit if you have the personal side of it, or if you have business lines of credit and business credit cards to help you build up your business credit. So they both apply on improving and enhancing your credit profile. Now let's talk about line of credit versus credit card on 0% offers. How you hear about these 0% offers. With the line of credit at the bank, they don't offer 0% APRs on purchases. They don't offer 0% APR on balance transfers. When you have a line of credit, it's an actual line of credit. You have an annual interest rate assigned to it. You have a minimum monthly payment when you draw on that line of credit, but you don't have any of those perks like credit cards do. You'll see credit cards do offer those 0% intro APR on purchases. That's when you activate the card. You get a new card. It comes with that benefit. Typically, banks offer 6 to 15 months on 0% offers. That's a benefit for you if you're looking to make a purchase and you want to have 0% basically cash-free money for a short duration of time. That's a benefit. The other thing is credit cards have 0% balance transfer opportunities. That's another big benefit. And what that means is if, let's say, you have a credit card debt where you're paying 19% interest rate on, and then another one of credit cards that you do have offers 0% balance transfer for, let's say, 15 months. So basically, you can transfer the debt on the one card where you're paying 19% interest rate on and transfer that over to the card with 0% for, let's say, 15 months they're offering you. So now you just dropped your interest on that debt from 19 to 0%. But that particular card issuer most likely is offering you the 0% balance transfer. They're going to have probably a balance transfer fee, which will be 1 to 3% of that transfer amount. So that's a small fee you're going to incur, but to get 0% for 15 months, that's a great benefit. So that's how credit cards are very beneficial there. That's the difference between a line of credit and a credit card. Now let's talk about interest rates. How are the interest rates different between a line of credit versus a credit card? Lines of credit have interest rates ranging from 7 to 15%. That's going unsecured lines of credit. Now, on the secured side of lines of credit, you can get much lower rates from 4 to 6%. So you're probably more familiar with HELOCs, home equity lines of credit. You're backing that line of credit with equity that you have in an investment property or even your home. So that's where you can get a much lower line of credit rate if you're pledging collateral to secure that line. Where if you want completely unsecured, then you're looking at 7 to 15%. Now with credit cards have fixed and variable interest rates for purchases, which range from 9.9 to 19.9%. That's the typical range for your annual interest rates on credit cards. Now the majority of credit cards in the marketplace have variable interest rates. So they go up and down. There's your prime, and they add a few percentage on top of your prime. So they're always fluctuating, where if you get a fixed rate credit card, that's a fixed rate. Now, majority of card issuers or banks that offer fixed rate credit cards are credit unions. So just the majority of credit cards are always going to have variable interest rates. Now, credit cards have interest rates for cash advances that range from 21 to 25%. So that's a much higher interest rate when you pull cash out on a credit card. So obviously you'll see some of the videos. At the end of this video, we have two different additional videos you definitely want to look at, which I'll point out to you in a minute. But credit cards also have penalty APRs. So what that means, if you're late 30 days on a credit card payment, they have other penalties, or you go over the limit, then your interest rate can actually skyrocket to 29.99%, up to 29.99%, depending on what the terms say. So those are just the difference between interest rates, and you want to be very aware of that. Okay, so A minimum monthly payment, there is a difference between a line of credit and versus a credit card. A line of credit has a little bit of a higher minimum monthly payment than a credit card. So when you draw on a line of credit and you have a revolving balance, you don't want to pay it off, you're going to have to pay 2 to 5% of the outstanding balance that you have in that line of credit. Depending on the bank, it may be 2%, it may be 3% or 4%. Many of them don't go to 5%, but it's a little bit higher than a credit card. So for example, if you have a $10,000 balance you drew on your line of credit, then your minimum monthly payment is the minimum amount's going to be $200, but it can go as high as $500. But typically it's between the 2 to 4% range. Now with the credit card, you have a much smaller minimum monthly payment, so it's a much easier debt to service compared to a line of credit. So you're looking at 1 to 2% is the standard minimum monthly payment on outstanding balances with credit cards. So if you have the same $10,000 balance on a credit card, then you're looking at a $100 to $200 minimum monthly payment. So that's something you also want to be aware of, is your minimum monthly payments between a line of credit versus a credit card. Now let's talk about reward programs. Lines of credit do not offer rewards or bonus programs. Lines of credit don't offer any type of cashback rewards or signing bonuses, where credit cards you do. You have various rewards and bonus programs. You have cashback rewards, sign-up bonuses. You have the 0% introductory rate offers. So that's your difference between a line of credit versus a credit card. Access to cash. This is a big one. If your goal is to get access to as much cash as possible for real estate investing, or you need it to put into working capital to make payroll, etc., then a line of credit is very beneficial because you could draw 100% of your limit with no fees, no cash advance fees. So if you have a $50,000 line of credit at the bank, you can draw $50,000 in cash from that line of credit. No problem. And you have no high APR cash advance rates. You just have your regular interest rates that's assigned to that line of credit. So let me break that down for you. If you have a $50,000 line of credit, you pull $50,000 in cash and you have a deposit in your account, then now you have $50,000 cash. So your minimum monthly payment on that $50,000 that you just drew is going to be anywhere from 2 to 5%. And then let's say your interest rate on that line of credit is 8% annual APR. And that's as simple as that, how it operates. Now, with a credit card, you have the same cash advance capabilities, but many credit cards have restrictions. They have caps on how much cash you can pull off your credit card. Some of them cap it at 20%. Some credit cards go up to 100%. So with our credit card funding program that we do, we help you obtain at least one card with the highest cash advance capability possible. That way, that one card can be the card that you use to pull as much cash as you can, and then you just balance transfer those out to the other cards. So that way you are avoiding this high interest rate cash advance rate. So credit cards have a cash advance fee, typically 3 to 5%. So not only does a high cash advance interest rate kick in on that balance, but you also have a small fee when you do a cash advance. But you can avoid that cash advance rate, that interest rate, by doing what's called the balance transfer strategy. At the end of this video, there's another video we go into how to take advantage of the balance transfer strategy and get 0% on cash when you pull out from credit cards. So lines of credit are much more convenient when it comes to pulling cash out. You could do the same thing with credit cards. You just have to be more creative to avoid those high interest rates, okay? But it's doable, that's for sure. Now, on the bottom of each one of these slides, I just want to let you know, check out our site, businesscreditbuilders.org. We provide you all of our funding programs, from lines of credit to business credit card funding to loans, etc. Now that we went over the difference between a line of credit versus a credit card, now we're going to break it down between personal lines of credit and business lines of credit, personal credit cards and business credit cards. We're going to share with you what it takes to qualify for each one. Okay, so let's get started. Now, personal line of credit, now we just went over how the lines of credit used. Now there's what's called a personal line of credit or individual line of credit. When you want to apply for a line of credit at a bank, they're going to look at, there's two main factors that they look at. They look at your personal credit worthiness, which is your credit report. And they also want to look at your income, your income that's verifiable. How much do you make a year? And what type of income do you make? Can you verify it? So first and foremost, you have to be able to verify personal income to get a line of credit. If you can't document your income, like provide W-2s, pay stubs, or tax returns that show your personal income, this disqualifies you for getting a bank line of credit on the personal side. So your credit scores need to be the 680 or higher FICO score range, and that's on all 3 of your credit reports. That doesn't mean that the banks or credit unions will pull from all 3 reports. They may pull from 1 or 2, but it's important that just depending on what bank you apply for, and with our program, we'll place you with the bank where you have the highest score. But you want to make sure you have 680 or higher credit scores on all 3 bureaus. There are other factors that come into consideration, which we're going to get into towards the end of this presentation, where we talk about your credit report, what the underwriters are looking at. But credit partners are also something like having a joint account applicant with you, a co-signer. Most banks do accept that. 25 to 300,000 you can get in combined credit lines. We do personal lines of credit with our funding program. So if you want to apply and see how much you qualify for, if you qualify for that particular program, you can order your report at businessfundingengine.procredit.com. That's number 1. Once you order your report, then you're going to submit your report at businesscreditbuilders.org/bank-lines-of-credit. So when you go order your tri-merge credit report, that's all 3 credit bureaus blended into one report. It only costs you $1 to obtain your report on this site. They have a great service which you want to consider on monitoring and protecting your credit, etc. But you want to go in and log in once you sign up and download the report, click the PDF option, download it in PDF format, and then you're going to go to this website here where it says submit. Okay, so that's your personal line of credit requirements. We're going to talk about the business line of credit, what it takes to qualify for a traditional business line of credit. This is an actual line of credit at the bank. Now, when you want to get a traditional business line of credit, there's much more involved than simply having good personal credit. Okay, it's great to have strong business credit reports as well. That just helps the bank assess the creditworthiness of the business. But what most people fail to realize, they think just because they have strong personal credit or just because they have a strong business credit report, that's all they need to get a traditional business line of credit. That is not the case when you're going to the bank. Traditional business line of credit, they require 2 years minimum business tax returns, 2 years your personal tax returns. They're going to do a personal credit check. They may not require personal guarantee if you have strong business credit financials, etc. But it does require much more financial documentation. So a traditional business line of credit at the bank, be prepared to supply your financials for the business, okay? You're not going to be able to get a traditional business line of credit by just having them pull your business credit report, okay? You're going to have to supply this additional information. Now, 680 credit scores is what you're looking at on the personal side minimum. 2 years business tax returns. Many banks do not like to give a traditional business line of credit for startups or if you're less than 2 years in business. To them, it's too risky. They want to see a track record. So I want you to understand what a bank line of credit for the business is. You're pledging your business. You're saying my business can support a line of credit at the bank. So what do you need to prove to the bank? You need to show that your business can support that line of credit. So even if you're doing $250,000 in revenue, $500,000 in revenue, if your tax return shows that your business has a loss every year, then it can't support a line of credit. And they look at your net income for the business. After the expenses are made, they do add back in depreciation, of course. But after you have your revenues and all deductions have been made, but they add back in depreciation, if there's not enough net income to support the line of credit, you're not going to be able to qualify for a traditional business line of credit at the bank. That's why business credit cards are such a popular funding program, because they're stated income. You don't have to provide all this documentation. So if you're looking for a traditional business line of credit for your account, for your business, be prepared to supply this documentation. But if you do qualify, you can get substantial credit limits. Again, here's how you apply. We'll do the review for you. businessfundingengine.procredit.com. Order your tri-merge report. You want to fill out the form where click submit, upload your report. We're also going to send you a business application along with we're going to require these other documentations, your tax returns for the business and your 2 years personal tax returns. We do accept credit partners for a traditional business line of credit. Okay, so let's talk about another business line of credit with an alternative lender. Now I was talking traditional. Now this is a non-traditional way to get a business line of credit. So there are various types of lines of credit you can get for your business. At the end of this presentation, be sure to check out our unsecured business line of credit video where we give you 3 sources of lines of credit you can get for your business. So that's very important. You want to watch that video. I'm just covering 2 right here. So actually, we're covering more than that because we're going into business credit cards as well. But with this particular lender, there's no credit check on you personally. There's no personal guarantee. Now, the requirement is this particular line of credit is based on your deposits. It's based on your business's revenue. How much deposits are coming into your business checking account. So you at least have to have $2,500 a month in deposits coming in every single month. That's the minimum. They do credit lines up to $100,000. They can do the review right online. You just sync your business bank account. They accept over 12,000 banks. They analyze your business deposits and they'll provide you a line of credit within an hour or 2, and you can actually draw on your line right online and have the funds deposited in less than 24 hours. This is another great way for you to get a business line of credit if you don't want to supply all that documentation, okay? If you want more details, go to banklinecredit.com. That's where we'll take you to our post where we go into this program in much more detail and exactly how to apply right online, okay? That's banklinecredit.com. So, now that we talked about the personal line of credit, what it takes to qualify, the business line of credit, but we talked about the traditional business line of credit, and we talked about the non-traditional business line of credit. Now we're going to talk about credit cards, a line of credit versus credit cards. Now we're going to talk about how to get personal credit card funding and business credit card funding, and what's the difference, qualification between the both. Okay, so let's talk about personal credit cards. Now, before I get into this, I want you to know you obviously can go out and apply for personal credit cards on your own. You don't need to go through a funding program like ours for personal credit card funding. But if your goal is to get the highest credit limit approvals possible for personal credit cards, definitely our program will do that for you. Because remember, the size of the credit limits you have on your personal credit reports will help you qualify for much more funding for your business or much more funding in the future for other additional funding. Because banks look at the size of your credit limits. That is a determining factor. If the highest credit limit you have is only $1,000 or $1,500, whereas let's say you have a $10,000 or $20,000 credit card or $50,000 credit card on the personal side, that shows that you have much more credit power compared to having small credit limits. So, to get personal credit cards, with some of the major card issuers, you need to have at least a 680 credit score, okay? Sure, you could get store cards with 650 credit scores or 600 or even 550 credit scores for getting a store credit card or some secured credit cards. We're talking about more higher limits, unsecured cards with more of the major credit card issuers. This is stated income, so credit card companies don't require you to provide financials or tax returns or income verification. So that's why credit card funding is so popular. Utilization, you want to make sure you're at 50% utilization on your existing credit cards. Okay, so if you have existing credit cards, you want to apply for more credit cards. On the personal side, make sure your utilization, your individual cards and your overall credit utilization is under 50%. That's ideal. Now, for our program, we get you 3 to 4 personal credit cards, and we also can add business credit cards to the mix, which we're going to get into in a minute. Okay, so 0% intro APR on purchases for 6 to 15 months. With our particular personal credit card funding, you can get $25,000 to $75,000 in combined credit limits personally. This is great if you're looking to build up your personal credit. You're looking to strengthen it so you can qualify for more business funding in the future. Because remember, personal credit does play a factor with many types of business funding programs. Not all of them, but it just helps you qualify for more. It gives you more leverage, okay? So if you're looking to see how much you can qualify in personal credit card funding, again, go order your Tri-Merch report at businessfundingengine.procredit.com. Then you're going to go to our Business Credit Builders pre-qualification page. You'll see the link right here on this particular slide. Now let's get into business credit card funding. Okay, so business credit card funding is ideal if you have a business, you're a startup or an existing business, and let's say you've been using personal credit cards and not business credit cards. Or let's say you have business credit cards that report to your personal credit, and you want to get away from any of your business showing up on your personal credit. This program is perfect for you because this program allows you to get 4 to 5 business credit cards in your company's name issued to you, the business. Yes, you're the personal guarantor. You're providing a personal credit check because you're basically co-signing for your business. But as far as credit reporting goes, none of the activity or debt you carry on these business credit cards will report on your personal credit. Okay, so minimum 680 credit scores with this program. Stated income, this is great if you don't want to provide financials. You can't prove business income. You can't prove personal income. This is a no-doc program. Okay, so credit utilization should be at or below 50% as well. With this business credit cards, you can get 0% intro APR on purchases for 6 to 15 months. And you get $25,000 to $150,000 in combined credit limits. Okay, so again, same process. If you order your report, then you can submit it right here on this link at businesscreditbuilders.org/pre-qualification. Now, I want to kind of go into credit reports, your personal credit report, and why it's what should you be looking out for before you apply for any of these types of funding, because I want you to understand what underwriters look at, because it's one thing to have good credit scores, but it's important when you realize that you can have a 730 credit score, 720 credit score, and get declined. Why? Okay, we have that happen all the time where people don't qualify for business credit cards and they say, well, I have a 730 FICO score. Why can't I get business credit cards for my business? Well, because there's many other factors that go into that. They may have too little of recent credit history. They only have a year's worth of credit history. Or let's say the reason why their credit scores are high is because they have all authorized user accounts. They don't have any primary accounts. Or they may have excessive inquiries. Or they may have opened 4 or 5 new credit cards in the past 7 months. So we can't get them business credit card funding because they have too much recent activity, too many new accounts open. So there's all these variable factors that go into it. So I want to kind of break down some of the most important factors for you, so you can keep an eye on certain things on what underwriters look for. So let's get into first is the age of your credit history. Now you can see, I kind of broke this down to make it as simple as possible, is if you have less than 2 years of credit history that's active right now, I'm not talking about cards that you had for 5 years but it's closed a year ago, you lose that active card history. Okay, so activity is key, is keeping those active accounts going. Don't close them out, okay, because they look at your active accounts. So less than 2 years is very new credit history. 2 to 3 years is still pretty new. When you're getting into 4 or 5 years of credit history, you're getting much more favorable in the eyes of banks and lenders and card issuers. Okay, the second thing is your active credit cards. This plays a role when you're trying to get credit card funding, whether it's personal or business. I talked about the credit limits playing a big role, and they do. When you have large credit limits on the personal report, it impacts your business credit cards qualification. It also impacts the size of the credit limits you're going to get on future personal credit cards as well. So they look at your primary accounts. They look at the age of the card, how long have you had it, and who issued the credit card. So just because you have a credit card issued by, let's say, a Walmart, and let's say Walmart, it's a store card and it has a $10,000 limit, that doesn't play as strong of a factor, whereas let's say you had a Capital One credit card with a $10,000 limit. They're same limits, but 2 different issuers. Walmart has much easier credit criteria to qualify for that amount compared to a Capital One. So, and then if you look at a Capital One, if you have a $10,000 Capital One, but you have a $10,000 American Express. Obviously, American Express is a major card issuer as well as Capital One, but American Express carries much more weight. Much more restrictive card issuer. They have much more stricter credit requirements compared to a Capital One. So that's where you want to look at not just your primaries, the age, but who's issuing the card to you as well. Those all play a factor. So like I said here, $10,000 credit limit over 5 years with American Express. That's a perfect scenario for what gives you a strong look at when underwriters look at your report. Is they look at the issuer, the age, and your primaries. Utilization. Now this is credit card utilization. Now if you have high credit card utilization, let's say you're at 60% or 70% and you're not sure if you're going to qualify, don't pay down your cards yet. Let us do the review so we can tell you, so our underwriters can point out which particular cards you have to pay down and what amounts. So this will help you conserve your cash. That way you're not paying down something you don't have to. Some cases you may have 60% utilization and you qualify and you don't have to do a pay down. Okay, so that's just something to consider as well. Now, you'll see here you may have to do pay downs if you're in the 50 to 74% range. If you're under 30%, then most likely you're not going to have to do any type of pay downs at all. Now, one thing I want to point out that's important is what underwriters look at, and when it comes specifically to business credit card funding, is if you have let's say you have 5 credit cards, and all 5 of those credit cards have balances on them. What's important is you want to at least keep 2 of your cards, at least 2 with 0 balances. Card issuers don't like to see you have balances on all of your credit cards. Okay, they like to see at least 1 or 2 with 0 balance. So when you're applying for a funding program like ours, it's nice to have, I'm saying don't pay it down yet. Let us do the review first. But more than likely, you're going to get higher qualifications when you have some 0 balances on at least 1 of the 2 of your cards. Now, if you only have, let's say, 2 credit cards and they both have balances, that's okay. But I just want to know, if you have multiple cards, then at least 2 of them should have 0 balance. Okay? So let me give you a real quick breakdown of an actual business credit card client of ours. Went through the program, 25 days. We got them $95,500 in credit for the business. Their credit scores were in the 750s. They had some credit cards. They had the highest card they had was a $17,000 Chase card, but they had it for 12 years. So that was a long history. You can see there a lot of age there. They were the primary, only 2 inquiries, and the business was a year old. So that plays a factor too, just so you know. If you're a startup or existing business, so let's say you want to get business credit card funding and you have 2 companies. One company you just formed yesterday. Another company, let's say you've had for 2 years. Which company should you use to get credit card funding for the business? If you can choose, use the aged business. Banks like to see age on your business. That shows longevity, that shows stability compared to a startup. Okay. Here's another actual client that went with a combo. We got them business and personal credit lines. We got them $141,800 in less than 30 days. This is the amount of credit we got for them. And the credit scores were very good. They were in the 800s. They had all types of credit, mortgage, auto, installment, and credit cards reporting. Highest credit limit they currently had was a $22,000 Chase account with 13 years. They also had a $20,000 B of A account. So, and 2 inquiries. So there's a little pattern here that you can see that low inquiries, high credit limits on the personal side, that does play a role with all types of funding. Okay. Now, and the business was 3 years old, so they had the trifecta here, what I like to call it. So, if your goal is, we've given you some instructions on each type of funding for line of credit versus credit cards, personal and business, how to qualify. We gave you ways to apply for each one of them, but if your goal is to say, you know what, I want to see how much I can get with everything. I want to see how much I can get in personal lines of credit, business lines of credit, or let's say business cards, personal cards, loans, etc. I just want to get as much as I possibly can based on my personal credit worthiness, my business or my personal income, my business income, etc. If you want to have a complete review, then you can go to businessfundingengine.procredit.com. First, order your tri-merge report. That's number 1, step 1. Step 2 is download the report. Step 3 is complete the pre-qualification form and upload your tri-merge report at businesscreditbuilders.org/pre-qualification. This will allow our underwriters to do a complete review on your credit, provide you the funding projection on what types of funding you qualify for based on your credit worthiness and income stated or verified, etc. at this time. And we'll get back to you in 24 to 48 hours to give you that funding projection. Okay, so our funding process, if you decide to move forward, takes 14 to 20 days. And once you receive funding, you can then access your lines of credit or your cash within that time period. Now, be sure to check us out at businesscreditblogger.com for more information. If you found this information helpful, please give us a thumbs up. Click the subscribe button. That'll allow you to subscribe to our YouTube channel so you get updates every time we post a video on new business credit funding products, personal credit funding products, how to maximize your personal and business credit so you can maximize your funding ability. So with that, make it a great day. We'll talk to you real soon.